Most people that invest in the stock market do so through their 401k or retirement accounts. They designate a certain percentage to be taken out of their check and automatically put it into a mutual fund like the Fidelity Fund or a S&P 500 index fund. Over time, it typically makes 7 to 10%, just like the S&P. However, what if you want to grow your money faster than the S&P? In this video, we discuss what is passive and what is active investing. Is passive or active investing better? What is the best way to actively invest? And we show you how to actively invest using a real example on the option trading platform.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do just buying stocks alone. Also, please hit the like and subscribe buttons below. I appreciate it and it helps the channel. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Passive investing is a long-term strategy in which you buy stocks and hold them for an extended period, usually years or even decades. The goal of passive investing is to ride the ups and downs of the stock market over time and ultimately end up with more money than you started with. Many passive investors believe that trying to beat the market is a fool's game and that the best way to make money in stocks is to buy them and let them do their work. Active investing is a short-term strategy in which you buy and sell stocks or options frequently to make money from the market's ups and downs. Active investors believe that they can beat the market by timing their trades and making smart decisions about when to buy and sell. Many active investors use stock options to increase their profits. Is passive or active investing better? It really depends, since there are advantages and disadvantages to both passive and active investing. There are a few advantages to passive investing. First, it's relatively simple to implement and maintain. You could put your money into a SPY ETF that mirrors the S&P 500 and be done. You could also hire a financial planner and have him or her manage your portfolio for you. This is another way to passively invest. It also doesn't require a lot of time or effort to be successful over the long term. Stocks have proven to go up over time 7 to 10% on average, with some years more and some years less. However, it can be a very effective way to build wealth over the long term. The main disadvantage of passive investing is that it can be difficult to achieve above average returns. Since you're not actively trying to beat the market, you're likely to end up matching the market's performance. And if the market goes through a prolonged period of decline, as it did during the financial crisis of 2008-2009 or the COVID pandemic in 2020, your portfolio will suffer as well. Active trading has several advantages over passive investing. First, it could potentially generate much higher returns. It does take some skill and experience to outperform the S&P or the market. However, if you study the market and follow a disciplined set of rules, it is possible to beat the stock market or the S&P 500. Secondly, it can protect against market declines. Of course, no one typically sees market declines coming. So for active investing to have a leg up in this area, you have to be able to either pick the market direction, which is difficult, or use a smaller percentage of your available cash to make the same or better returns as you would do if you were passively investing. It is difficult, if not impossible, to correctly predict direction in the market. Even the best active traders only get it right about half the time. A set of rules and always having money on the sidelines is the key to being successful. Lastly, active trading can be an exciting and engaging way to invest. It's much more fun to be engaged in the stock market. Knowledge is good, and more people trading options means more liquidity, growth, and stability for the market. The main disadvantage of active investing is that it's a more time-consuming and resource-intensive strategy. You need to monitor the market and make trades when opportunities arise. What is the best way to actively invest? Selling option premium is much more profitable over the long run than buying options. If you want to know more about that, download the free workshop. Here's an example of how to actively sell a strangle in Bank of America. We go to the Tasty Trade options trading platform. I'll put a link down below. It's the best and most intuitive option trading platform. We punch in ticker BAC in the upper left and see the implied volatility ranking is 62, which is high and good for selling a strangle since we can collect more premium with high IV. We open the option chain that is closest to 45 days to expiration, as that is the sweet spot. So we open the May 2023 option chain with 57 days to expiration. We click on the bid to sell the 25 strike put option since it's closest to the 25 delta and the bid on the 31 call option. We collect $1.35 or $135 since one option contract controls 100 shares of stock. We then switch to the curve mode and see the profit zone in green. As long as we stay above the 25 short put strike and below the 31 short call strike at expiration in 57 days, we keep the entire $135 collected up front when we place the trade. In reality, we most likely won't hold the trade that long. At 15 to 21 days to expiration, or when we receive about half the profit, we will either close the trade for a winner or roll to the next month and adjust by centering the strikes if the IVR is still high and we still like the trade. There is a place for both active and passive investing. I recommend always first investing passively in your retirement and or your 401k account. You just take 10 to 15%, the maximum if possible, out of your check every month and let it passively earn the 7 to 10%, mimicking the S&P 500, and over time it will grow. However, if you're extremely interested in companies, stocks, and the financial markets, then actively investing can be a business in itself for you. Businesses can go bankrupt and they can also make a lot of money. You need to always remember that in the long run, your active option trading account is just like a business.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.